Hi there, welcome. May 8th, 2020. And wish everyone an early Mother's Day holiday weekend. In the Northeast, a little drizzle and rain. And last night, there was a spectacular supermoon for anyone that was able to capture it. This is our first screen. I have a little image playing off of our aspirational pursuits every day for life, liberty, pursuit of happiness. Supermoon of the peculiar times that we're living through at the moment. And thought we would do a follow-up webinar on giving people some perspectives on Sam's PPP ideology, philosophy. So we came up with the idea of sharing some perspectives about the idea of thinking about profitability from a perspective of long-term, sustainable, multi-generational families and relationships, as well as helping each person that we've been grateful and fortunate to serve to help find their path to a profitable future with some of the perspectives we may share with you today. So we have set aside about an hour, but if anyone has any questions, if anyone hasn't figured out how to use Zoom in the last 60 days, there is a chat function on the toolbar that you can put in any questions. We have some questions that were posed the last several days, but thought I would add to it. Forgive my squinting. I happened to misplace my glasses yesterday, so maybe it was a sign that I've been reading too much, squinting. So I took the opportunity to try to get some perspective of how I could see the world without glasses for a couple of days. A new pair's on order. So a little perspective, just to start with a little fun. This is a image Louisa shared kindly to give someone a perspective of how we show up every day in the world. You decide. Do we show up happy? Do we show up sad? There are certainly a lot of reasons to look at the lens through whatever lens that is impacting your family, friends, society, community, jobs, country, world, politics. We're going to try to avoid hitting controversial topics, but as a steward of people's financial futures, we wanted to give a little perspective that you do have an opportunity to decide the lens you want to see the world. And as wonderful coach Dan Sullivan had shared with me a number of years ago, our eyes only see and our ears only hear what our brain is looking for. And the reason this has struck me so profoundly is because you can look and see evidence for a positive perspective or a negative perspective in every situation. So we're going to try to be a little balanced today and give you some of our perspectives that may help color your lens. And the idea of coloring someone's lens, we have a little experiment in the chat box if you want for your own fun. I would be interested to see what color the people participating in this webinar see on the shoe. And if you want to throw in the chat function, just click on the chat and say whatever you see. The answer is beneath, and the reason why I posed this question is because depending on your perspective, even in an individual family of 5 that I have, in my own family, we had some people that saw green and beige, and we had some people that saw pink and white emphatically. So emphatic, there was almost family fights that it was so clear that it was pink, and it was so clear that it was green and gray, and it led to family tension, which was fabulously, phenomenally wild to see. And so our eyes really do see this image totally different. So my first blush, the colors that hit me most profoundly, personally, happened to be green and gray. But as some of my family members emphatically see it as pink, I look a little closer and I can actually see the pink. But I have to really change my lens a little in order to see the pink. But I couldn't see it initially. I didn't want to say you're wrong and I'm right. I just had to squint a little more, and coincidentally, I did find my glasses, so I can squint a little more and say, huh, that is actually pink. Interesting. So we're wired differently. Some people are left brain, some people are right brain, more dominant, and that causes us to bias our perspectives. Some people are more analytic. Some people are more creative. And it really depends on your genetic disposition. I may be a little ambidextrous, the fact that I can see pink and green, but maybe in the current climate, it would be healthy to pause before placing judgment on anyone to gain a little perspective at the lens through which they're seeing the world in a compassionate way. So now let's talk about the current landscape. As I see many people responded, thank you for your responses on the chat box. Gray, green, pink and white, gray and green, green and beige, gray and green, gray, turquoise, pink, white. So people see it with a different lens. So here's the current landscape. Fear and volatility. What is driving the bus? In the first 4 months of this year, we had started the year through the middle of February, relatively calm. This is showing the up and down movement of the S&P 500, a barometer for a temperature gauge for the financial state of the US economy. And the temperature gauge of the emotions were relatively calm through the middle of February. And then come mid-March, as the recognition of the potential of coronavirus turning into a global shutdown caused people to recalibrate literally daily, depending on how it was going to impact their lives, their families' lives, the financial markets. And this recalibration caused extraordinary volatility for an extended period of time that we're still living through. And this extraordinary volatility causes many people it wears on people's emotional fragility, because there's real and or imagined things that are happening in people's lives. So fear, the acronym is future events already realized. So part of the talk today is how do we combat fear? And so one of the things that is the first response when everyone is hit with fear, because we have an animal lizard brain, the vast majority of the population goes into fight or flight. Forgive me for this image being a bit blurry, but what you see is bank deposits. So bank deposits passed 10 trillion in a blink of an eye, US deposits into US commercial banks from the previous quarter during this time, which is logical because people are going into fight or flight and absolutely piling their money into cash. And now I want to share some perspectives about this. Fear is the path to the dark side. Our wise Yoda grandfather, fear leads to anger. Anger leads to hate. And hate leads to suffering. I'm going to pause just to reflect on it. I know it's peculiar for a financial person to talk about Yoda as a inspiration, but being very emotionally connected to stewarding my family's finances, my own finances, friends, people I love and care about, this is personal for me, so I can feel the fear and the angst of what people are experiencing, because we all want to make sure that we're safe and that we have sustainability to our health and our financial stability for a lifetime. But fear definitely doesn't lead to good decision making, in my experience. So what are signs of fear-induced behavior? What happens when people are triggered with fear? Well, first thing they do is they try to predict the future on an extreme, on a good or bad situation. I know what is going to happen, and it's not good. And then on the other extreme, if we did combat fear, there might be fear of missing out in the last several days or weeks. Why not just own the stocks that everyone knows are going up? Just own Zoom, Amazon, Netflix, and Facebook. Or in the last month and a half, I have no interest in being invested during the next 6 months because the markets are definitely going lower. And or comments that we've got from clients is, I don't want to hear anything from you. I just want my money safe. I just want my money in cash. I do not want to be invested through this volatility. It's just, I don't want to hear anything you have to say. Just put me in cash. And they end up acting on impulse. I can't take this bear market. I'm getting out. Everybody I know is out of the market and all in cash. Everybody's making, and then the flip side, some people say, well, everyone's making money. I want a piece of the action. So there's fear of losing money, and then there's fear of missing out. So fear is really unhealthy to your DNA on both directions, the fear of loss and the fear of missing out. So we want to give you a perspective of how toxic fear is to your health, and it wears down your immunity system, that it leads to both bad decision making and it makes you more vulnerable to a lot of poor impulses. So I remind you of Blanche's wise words, beware of laughing tickets. People bet their savings on tips and hunches. I got a hot tip from a neighbor, it's a slam dunk, why don't I buy this? Or I heard it on the news, I better sell. The newscaster said I had to sell. Or my friend works in the industry, he's got the inside scoop, he knows. And people, we work with people of all ages, from newborn to 100 years old. So we have a lot of lenses, a lot of different perspectives that we speak to every day that really help us frame our perspectives. CEOs of companies that are really in the heat of the situation. People in every industry, from the cruise line to banking to technology, law, medicine, social work, philanthropy, government work. We're blessed and fortunate to have clients that span the gamut of various industries. And people are generally biased by the lens of where they're sitting. If you're in an industry that is laying off a lot of people, your lens is going to be colored by the industry that you're impacted by, or in recruiting, or fashion, or restaurants. People I love that are in the restaurant industry have had to lay off, a tremendous number of employees. So it really colors your lens quite a bit. And then the last thing that fear and volatility causes a perspective of a lack of discipline of someone's long-term path is getting swayed by the media. Right now, because many people have a lot of time quarantined, I know I have spent, maybe again, the glasses were lost intentionally, I've spent a tremendous amount of time on screens, and technology has filtered the screens to let in the information you want to let in, to enable you to create a little filter bubble on what you want to see. So the filter bubble of what you want to see is going to color that lens. And today, this morning at 10:34 in the morning on my phone, I took a snapshot of it. New York Times, US unemployment rate hit 14.7%, worst since Great Depression. A devastating 20.5 million jobs were lost in April. Well, this is today's headlines. In looking at this, this is terrifying on the surface level of reading the information. So that causes me immediately to go into fight or flight. Like, I got to call my financial advisor. Is he not paying attention to the news? How does he not see what's going on? Why is he not seeing that we're going into depression? Shouldn't we sell everything? Don't you know that we're going to go into a crash? Isn't it obvious? Everyone knows that. So let's just take a different perspective and just give you a little framing of my lens to try to flip it from the negative to the positive for a moment. There's 328 million people in the US population, 164 million in the US labor force. This is not the official count, but I'm projecting out, let's take out a really, the initial projections of the worst case of forecasting 30% unemployment if this global shutdown happens for a much longer period of time. If we have 30% unemployment, that would be 49 million people unemployed. What it would imply is that 115 million of our population is actually potentially unemployed, or that would be the percent that are working, and potentially 213 million people would be sitting home of all ages. Not only sitting home, but unable to socialize, unable to go out, humans are social animals. So we're staring at screens, interacting, but being isolated, ruminating in your own mind, it really takes Jedi training to get to a calm place. Maybe that's why I had the Yoda quote in there. It takes Jedi training to be able to protect the mind from ruminating, to get to a dark place, to say, wait a second, everyone's sitting home, no one's working. Of course, we're going to go into the depression. So I'm here to try to protect the people that we're able to influence, your mind, to try to minimize and protect the people we love from going into mental depression, fear, panic, that is going to have a perverse impact on your health and wellness for yourself, for your family, for your friends, for your community, for your loved ones, for your businesses, for your ecosystem, the ecosystem in that you can impact and control in your life, which that's all we can do is impact ourselves and then those people around us. So again, going back to the first reaction, level one thinking, the first reaction is, as you could see by this AAII report, just annotating, you can see, 75% of the population is both bearish and or negative about the future. So of course, if you speak to a lot of people, you're going to be influenced by the people you're speaking to. And certainly if those people that you're speaking to are negative and depressed and bearish because people are sick or suffering or dying or unemployed, or, there's just a lot of real, this is reality. There's a lot of real trauma going on in people's lives, not to be minimized. But trying to relate it to finances, this is a really emotionally tough thing to understand. And The Economist is writing a piece this weekend on it, why is there such a split between Main Street and Wall Street? I don't understand. I can't understand why the market's going up when everyone knows we're going into a depression. I don't understand. It just doesn't, it's not computing. For the logical brain, it's not computing. So going back to the shoe, whether you see pink or whether you see gray or green, you gotta pause and flip it on its head and try to look at it from a different perspective. So I'm gonna share with you a couple things to try to frame the lens. No judgment, whether it's good or bad. This is what it is. And this is a lens that I'm gonna share with you. How does the system work? GDP, or gross domestic product, is made up of government spending, business spending, consumer spending, exports, imports. There's other inputs and savings and taxes. But let's think about it. If 65% of the population is not working, and by the way, as Jason would like to correct me on this, a great percentage of the population is children, minors that aren't even eligible to be in the workforce. And then there's retirees that aren't intending to try to be in the workforce, they're retired. So the eligible workforce is smaller than the entire population. But nonetheless, if people are unemployed or worried about their employment, consumers are going to retract their spending. And businesses worried about their solvency because they've been forced to shut down is worried about their solvency. So if consumers and businesses, the immediate response to volatility was to panic. How am I going to survive? How am I going to get through this? Now, the interesting fact that happened as a byproduct of this, which I'll pass it over to Jason in a minute to cover, is in a response time, speed, and magnitude that's almost unparalleled, the government had stepped in with a massive amount of money to fill the gap of what is a massive hole from consumers and businesses during a short period of time. And everything has a series of unintended consequences. So that's to be told later. And that's where you have political debate of, what's the right thing to do, who should be supported, who shall live, who shall die, where should the money go? There's a lot of this about political rancor that you're going to hear in the next 6 months. At the end of the day, it's my view that the government did what needed to be done. They needed to step in a dramatic way to fill the gap. And that's how the system works, to keep the engines and the fuel, lifeblood of people's fabric going. So how do we overcome the pandemic of fear? For me, because I lost my glasses and because there's been a couple days that I've been able to get a breath of fresh air and not stare at screens for 20 hours a day, instead of sitting at a desk stressed and worried and feeling all of the anxiety of taking the weight of the anxiety of everybody's lives coming at me and trying to steward people and trying to help people make very calm, deliberate, thoughtful decisions about their future. The idea of trying to search inside yourself instead of searching the internet, searching Google, or searching the web for what you're validating your opinion. How about pausing, reflecting, taking a walk with the dogs, which I've been fortunate to do without any neighbors around me, just trying to get some fresh air, listen to the birds, listen to the trees, search inside myself and find some little inner peace of saying, what can I control? How do I raise my level of self-awareness of the impact that I'm having on how I show up for others, show up for my family, how I show up for my coworkers, how I show up for my friends? Am I spreading fear? The coronavirus is hard to contain. But a greater pandemic is the pandemic of fear. Am I spreading fear to my family, to my coworkers, to my friends, to the world? Or am I light in a world of darkness, trying to find some positive perspectives to help my friends, my family, my coworkers live a healthier life and spread that positivity to find optimism, and to find kernels of light in a world of darkness. And if each and every one of the people that I'm blessed to have contact with and hear this message and be part of this webinar, and I hope that I can do my part of trying to be a little more peaceful, be a little bit more self-aware, be a little bit more effective, and be a little happier instead of frowning about all the things that are out of my control, being a little bit happier. About the fact that I can breathe, the fact that I'm able to think clearly, the fact that I'm able to make a positive influence on the people that I'm grateful to serve. So going back to perspective and finishing this up, you have a choice. You can focus on 5 days, or you can focus on 5 years. So part of the PPP of perspectives, profitability, and path is trying to give you a perspective of thinking about it over 5 or 50 years. And it's just healthier for me to focus on 50 years versus focusing on 5 days to evaluate success or failure. That being said, I want to be present every day for the people around, to acknowledge that there's real things that cause people to focus on the short term, and we need to plan prudently for the short term so people can survive and thrive in the long term. And a reminder is a little late to generally ratchet down risk to sell assets after they've declined. It's like parachute training after you jump. So it's a good reminder that people do react to price movements more than they react to rational long-term thinking. And the grandfather of capitalism, which, you know, I own shares of Berkshire Hathaway personally, and for many people, to try to imbue a mindset, because I know I don't have all the answers. I know the future is uncertain. I know no one can tell you what tomorrow is going to bring, whether the markets are going to be up or they're going to be down. That's no one can tell you that. But I want to frame a perspective from Berkshire's conference that a lot of people, again, first level thinking, reacted to, as well as the headlines. Berkshire Hathaway reported $50 billion in losses, but I circled it to highlight this for people, is the idea that these $50 billion in losses were an accounting change. Most of it was because securities had gone down by $55 billion. But what you see also, if you, this is fascinating, what you see really fascinating, if you look at this, the operating earnings here, they actually increased operating earnings. They actually increased their profitability of their operating businesses. So the businesses generated more profit. The sad part about this, going back to employment that people have a disconnect to, is businesses have an obligation to shareholders who are investors of the business. And in that way of protecting shareholders, they need to run profitable, sustainable businesses. So as sad as it is for humanity, as businesses lay off employees to preserve cash and to preserve profitability so that they can sustain, survive, and thrive, the businesses become more profitable. There's a human cost, obviously, which is very unfortunate, but the profitability of the businesses increase. It's very hard for people to make that connection. It's very soulless in some ways because you want everyone to thrive, but that's just part of capitalism that people need to understand. I didn't make up the rules. I just have to share with you some of that perspective. So for that reason, in order to give you sustainable success, we want to be able to steward your finances for multiple generations, to design a path and plan for your profitable, sustainable future for multiple generations. And with that, I'm going to turn it over to Jason to take the lead, and I'm going to hush for a couple of minutes.
Thank you, Jonathan. So the first the first thing we need to do to frame transitioning from perspective is our minds. And as FDR said, men are not prisoners of fate, but prisoners of their own minds. Next slide. So how do we combat and heal our minds, right? Because everything's all about a mindset. The first thing we need to do is focus on knowledge and educating ourselves. So bringing back Yoda, we see when we're in a dark place, when we find ourselves, a little more knowledge lights our way. Through knowledge, you create power, and power creates the ability to see through the lens of the long term. Next slide. Next slide. So we wrote about this a little bit in our previous quarterly letter. Human beings, our brains are not created to focus on the long term. See, in our society, we have the ability to evolve. We've evolved society a lot, but our brains are still stuck as being cave people, right? And our brains have a lot of capacity in our long-term memory, but not a lot in our short-term memory. And this makes instinctual sense. So we have to think about a lot of very few things to get us through from being cave people to where we are today. So for example, when you saw the bushes rumbling, it just signaled our brain to run because it was a predator. When we saw a baby crying, it signaled our brain to pick it up, to soothe it. When we felt our stomach rumbling, it trained our brains to eat. So our brains still act like this, right? And interestingly enough, our brains are still have such little power that our brains actually run on less energy than the light bulb you'll find in your refrigerator, on anywhere from 12 to 20 watts of energy. And this causes our brains to only focus on the short term because we don't have the power to transition anything into the long term. And it also triggers stress and this fight or flight syndrome. So with that in mind, it makes sense to try to think about where we are today and previous knowledge of bear markets. So I've actually ran this experiment on a few of our clients through these past couple of weeks, and I simply posed the question, how often does a bear market occur? And every single time the answer has been actually 2 times longer than what is actually true. So I've seen any answers for anywhere from 15 years to 50. The truth of the matter is that bear markets actually happen every 7.5 years. So that means the average person lives to about 79 or 80 years old, right? So that means in our lives, we will see 10 to 11 bear markets. So a fair amount of them. Also, a lot of people start to think, well, this is going to last forever. Because again, our brains only know how to think about the short term. We can't think about more than 6 months or 9 months or today or tomorrow. But the truth of the matter is that typical bear markets from when you've seen them start to when you get back to even is typically takes about 3 years. And 3 years in the grand scheme of things is not very long. It's only about 3.4% of someone's life. Next slide. And to give you a better visual depiction of it, this is how small it is. So your life expectancy is in the green, and you have a little sliver of a bear market, very tiny Pac-Man face in terms of bear market. So that means if you want to think about it in a different way, if you see 10 to 11 bear markets in your life, that means that 33% of your life, you're going to see a bear market, or roughly a third, which means that 2/3 of your market, of your life, you're going to see great markets. So again, combating the fact that we can't think about the long term because our brains, our instinctual brains, aren't built that way, and combating the fear and realizing that 2/3 of your life will actually be positive versus 1/3 where it could be negative. Another way to combat knowledge is to think about things from a logical perspective and focus on what you actually own and what people actually own when they invest in what people call, quote unquote, the market. You actually own businesses. You own stakes in businesses. And the way that to think about how you get through things is to focus again on logic and owning the most profitable businesses. Every single one of these businesses on this screen right now, I would venture to say we all are using them during this downturn. Every single one of them, whether it be Amazon, I know we use this at my house, Johnson & Johnson, MasterCard, Nestle, Roche, LVMH, all of these companies, even though we're going through a downturn, every single one of these companies are being utilized. They're all profitable businesses. And what happens during bear markets is that people start to say which company will live, which company will potentially die. And what they know is that with companies that have ample profitability, ample balance sheets, ample free cash flow, those companies will survive. So people don't throw them away as quickly as companies where there might be an instinct that this company might not exist. And you actually can see that bear out in the data, where if you look at it from the United States, over time, owning the most profitable businesses have actually outperformed owning the less profitable businesses by an average of 3.57% per year. And internationally, about 3.63% per year. So yes, this is statistics, but also to gain knowledge, it's also to think about it logically, that profits are the lifeblood of business. Businesses need to survive through good times and bad times. So who do you want to own? You want to own the most profitable businesses to get you through both the good times and the bad times. It takes the guesswork out of the game, out of the picture. The other thing that, and Jonathan touched on this, is the stimulus package. Now everyone sees huge numbers, right? So huge numbers in the stimulus package. We had a $2.2 trillion stimulus package in 2020, which compared to 840 billion in the financial crisis, almost 3 times as large. Next slide. But there's some fundamental differences between 2009 and 2020. One of which are where interest rates are, and this is starting to touch on the profitability of the government. Right. So when as Jonathan said, our GDP works, we're mainly a consumer-based society and business spending. But when those two start to falter, the government is supposed to step in to balance things off. And how does the government step in? They finance things through stimulus packages and through interest rates. And interest rates are down from the last crisis from about 3.5% to only about 1.3% today. And this is the 30-year rate. Next slide. So what does this mean? What this means is actually, though the stimulus package was almost 3 times larger in dollars, is actually costing our government less money to fund this stimulus package than the last one. It's costing about $28 billion versus 29 in the previous crisis. Next slide. The other piece of this equation is that we're a much larger country. Since 2009, our GDP has gone from 14 trillion to about 21 trillion at the beginning of this crisis. That's an almost 50% increase. So interest rates are almost down by 1/3, and our economy is expanded by 50%. So what does this mean? Next slide. What this means is that the cost to finance this stimulus package is almost half as much as the cost for the past one. Because at the end of the day, whether you're a human being, a business, or a government, the level of debt that you take on is all relative to your size and your ability to service the debt. Right? Though debt is a 4-letter word, a lot of it has to do with your ability to service your debt, which is the way that most banks look at people, your ability to service debt, and the government's ability to service this debt has actually been cut in half since the last crisis. It's only going to be 0.13% of our GDP, a rounding error. So again, everyone talks about the level of debt of our country, which has gone up since the 80s, right? So it's gone up since 1985 all the way through current day. But again, it's not about necessarily the level of debt, it's your ability to service your debt. Next slide. So what's fascinating here is that the government's ability to service your debt, which is again, the amount of interest we're spending on our debt, that's actually gone down since the 80s. Why? Again, because two reasons, because interest rates have dropped and our economy has expanded. So as you grow as a person, as a business, as a government, and if your cost to borrow decreases, your capacity gets much bigger. And the ability to service your debt and to grow and to sustain becomes that much more vast. So again, now we're seeing the profitability of businesses, the profitability of our country, and then next, you want to see the profitability of the individual. So again, there's a lot of hype and a lot of media coverage about debt. Again, debt could be bad if people don't have the ability to service the debt. But what we've also seen is that the level of debt to household debt to GDP, now this is from an individual consumer standpoint, that's plummeted as well. So now during this downturn, we've seen the fact that we want to focus on the most profitable businesses. The government has become more profitable as well because the service and the ability for them to service this debt has expanded by almost 2 times, and households are actually a lot healthier. So there's actually some positivity versus fear. Next slide. And then to just give this even more perspective and to have some knowledge, a lot of people ask us, well, how does this compare differently from the Great Depression and the Great Recession and other things that we've seen? So there's 3 things that are going on here, 2 of which are not unique to this downturn that happen in every single downturn, which is monetary policy response and fiscal policy response. The one thing that is unique is the healthcare response. So let's just focus on the knowns, the things that we can control as a society. Those 2 are monetary policy and fiscal policy. So monetary policy is the response by the Federal Reserve, or James Powell, right? Who's the picture on the Fast and the Furious to the left. So the Federal Reserve, for some comparison, during the Great Depression, it took the Federal Reserve 18 months, or about a year and a half, to cut interest rates to only as low as 1.5%. So a year and a half. During the Great Recession in 2008, it took the Federal Reserve almost 2 years to cut interest rates to 0. This compares to the current crisis of 6 weeks. It took them 6 weeks since the first case of coronavirus in the US to cut interest rates to 0. So the response of the monetary side has been very fast, much faster than past crises. The second is fiscal policy. And fiscal policy is the response of the government to stimulate, from Congress and the president, to stimulate the economy, as we touched on earlier. In the Great Depression, it took almost 4 years for the federal government to step in to try to stimulate the economy. The Great Recession, it took 1 year. During this crisis, it took 7 weeks, and that was with a $2.2 trillion package. So again, the response to the crisis has both been fast and furious. Now, the only part of the crisis that we do not know of is how long the healthcare crisis will end. That is the only unknown. So the only thing that we have to look at as the worst case scenario from past crises is the Spanish flu, which we touched on in our last call. The Spanish flu took roughly 18 months. 18 months, and that was 100 years ago, right? Now, obviously, again, I'm not a doctor, and I do not know how quickly we can solve the current healthcare crisis. But again, trying to use some logic, we just try to say to ourselves, the Spanish flu happened 100 years ago. 100 years ago. And society, though our brains have evolved, technologically, we have evolved, healthcare-wise, we have evolved. So to think logically, will it last as long as it took 18 months ago? Again, nobody knows, but these are just some data points to think about and to ponder, right? So we've controlled what we can control. The government has done a fast and furious job stepping in, much faster, much stronger than the past two crises. And the only part that needs to be solved now is a healthcare crisis. Next slide.
Thank you. So our goal is to try to help each individual family that we are fortunate to serve help find their path. And in order to find their path, everyone's circumstances are unique. Going back to the Berkshire conference, everyone was like, well, he's bearish. He's got, $135 billion in cash. Shouldn't we be bearish too? And he made some if you listen closely, he made some very explicit comments to say that his obligation is based on his circumstances, and in calibrating his path and his decision-making, his obligations as an insurance company, for example, they're calculating potential insurance liabilities, which are somewhat hard to calculate because there's a lot of unknown unknowns. He didn't know that the government would step in with such speed and magnitude in such a short period of time. They stepped in so much to be able to help the unprofitable businesses, give them a lifeline with the PPP plan and SBA loans and other forms of stimulus, that he didn't have the opportunity to step in and get the deals that he would want, because he wouldn't give someone money at 0% interest. But what he did do is he went out and issued debt in Europe and borrowed $5 billion at 0% for the next 5 years because people were desiring what they perceived to be safe and risk-free. So he was opportunistic, but in a different way. He was taking advantage of the moment of the opportunities that were being handed to him. And at that moment, what was being handed to him was cheap financing. He wasn't given the opportunity to take control of a business under very good terms, but he was able to take advantage of the generosity of people wanting to lend him money at nothing. So circumstances, everyone has that we serve, our fiduciary obligation is to serve you based on your unique circumstances. So in order to do that, our desire is to collaborate in a way that we can help you focus on the things that matter and the things that you can control. So just a little fun levity. In the midst of this, April 22nd was Earth Day. One of the questions later that we'll come to is, oil prices went negative. It happened to what's very peculiar, talk about climate change and sustainability. I had a conversation with someone yesterday about it. Look, if you have a more profitable business, you can donate to the charities that you want, but investing for sustainability isn't always profitable. That being said, trying to do what I can control on the day that Earth Day, just coincidentally, I took a walk with my daughter, Erin, here in the picture. She's much more stylish than me. You see, I look like a homeless person, as my wife tells me she needs to, redress me. But we were picking up trash, plastic, bottles, stuff on the beaches. The magnitude of trash and garbage made me sick. And then, of course, turning on the news, it was actually very reassuring to say when humanity retracts, the rest of the world thrives. The ozone layer was closing. I think there was dolphins swimming in the Venetian canals. I mean, Mother Earth is healing. so all the toxicity of energy, which, as Jason would say, is not profitable businesses in general, exploration of pillaging the earth to be able to extract oil to sell it at a higher price. It hasn't been a very profitable business. So in a sustainable way, investing for profitability is sustainable because we're avoiding companies that may be on the verge of bankruptcy. So in thinking about translating all the lessons from business and from Buffett down to the individual level of family finances, taking the emotions out of it the best we can, and look at each family as a family business, not the emotions of the family, but how do we manage the family business? We want to control the controllables. And the things that we can control, we've identified 4 things. 1, balance sheet optimization. So financial planning is a hard thing to quantify. People that we've been grateful that we've gotten referrals during this crisis, and people come to us and say, well, what are your fees and what are your performance? And I'm like, if that's what you want, you can go to Wall Street and I'm sure someone's going to sell you fees and performance that they're going to outperform everyone. I have no idea that we can outperform anyone. In fact, 99% of people, as Buffett says, will absolutely underperform a simple S&P 500 index because of behavior, taxes, a host of reasons. I mean, so just owning the collective conscience of the world, you can do great over a long period of time, but that's not planning. And what we've spent most of our time on over the last 25 years and continue to is in the planning part. And the planning part is connecting to someone's goals, what it is they say they want, taking an X-ray of their finances and looking at it. I mean, for many people, it's the first time when we try to go through it every year. It's almost the only time that anyone actually objectively looks at the X-ray of their finances to look at their balance sheet from a business perspective. Look, if I take an X-ray and I don't want to cut off your leg if you have a broken arm, we got to look at your balance sheet and your cash flow, which requires a lot of technology and coordination and collaboration to understand your balance sheet, your liquidity, debt management, and how do we give you psychological safety that you can confidently steward yourself and make calm decisions. 2 is cash flow. And because humans are not wired to do this very well, their analysis causes analysis paralysis every day, thinking like they're going to outsmart everyone. Tell me who's going to outsmart someone every day as things are yo-yoing. I'm not smart enough to outsmart everyone. I'm just trying to, like Buffett, not do anything stupid. So if we can automate someone's savings, 10 to 20% saving for their future, and automate their spending when they're decumulating assets to spend in the 3 to 5% range, so they have guardrails to not overspend, where that they run the risk of outliving their money, is an important characteristic as well. 3rd step is investing, optimization, designing your path. Everyone isn't comfortable owning 100% equities. So we try to create an investment policy statement. I'll call it the path, your path. Everyone's path on this call is going to be different from one another, depending on your stage of life and your balance sheet and your cash flow and your liquidity. And we frame it in 2 ways. 1, we want to focus on your need, capacity, and willingness to take risk. The need and capacity are very quantifiable things. The willingness is a very temperamental thing. And the willingness, as we pointed out earlier, when someone hits fear and fight or flight, everyone's willingness goes to 0, as you saw by the rush to liquidity. But if we can right fit your path, call it a speed limit, 50 miles an hour, 70 miles an hour, 100 miles an hour, whatever speed limit that fits your temperament, if you really have a temperamental issue and you want to change the speed from 50 to 60 or 60 to 70 or 70 to 60, try not to go dramatically beyond a 10% swing so that you don't have regret and worry or that you made too dramatic a mistake of going fight or flight, which it's really painful for people that I love to see that happen. It means that we haven't done a good job of calibrating the right speed limit. So some people are comfortable at 55 miles an hour, and that's fine as long as that's going to give them a high probability of sustainability. And then we can focus on designing an operational system using technology to be able to focus on the things we can control, which is rebalancing unemotionally. And rebalancing unemotionally is huge value, because if you rebalance, the human brain isn't going to want to rebalance. You're going to say, I'm not buying that asset now. Well, if you naturally rebalance, you're buying things that are being sold. You're buying low and selling high naturally. So rebalancing is forcing behavior that your natural disposition just wouldn't do. So we need to structurally automate rebalancing. Asset location, we need to look at the big picture so that we can coordinate, once we figure out a speed limit, where do we place the assets, and retirement money and non-retirement money. And then try, because taxes are going to become a bigger issue, tax loss harvest along the way, in order to take advantage of dislocations in the market and maintain your speed limit to profit from dislocations. And then fourth is planning beyond the numbers. You know, Christine's on the call. I know she's graciously poised and standing elegantly, and she'll speak in a little bit, asking some of the questions that people pose to us. But you know, we have tremendous talent to provide estate and philanthropic planning, and Frank and Christine are working on helping people with multi-generational thinking and behavioral coaching to be able to get them to control the controllables. And my quant nerdy side, my gray and green side to the shoe, has me focused on the numbers. And this is not my stats. These are stats from a lot of sources, but the quantifiable information has shown that just focusing on the things that we can control can add 3% a year. I might not be able to outperform the market. Okay, I can't do it. I don't think anyone can. Maybe Buffett can, but 99% of the population are going to fail. We can generate 3% a year in value to someone's life if we can get the right structure properly on your path. And therefore, our goal is to focus at your big picture. And focusing on your big picture beyond just making investment decisions is the structure that people don't even think about from a planning perspective of the tax control triangle. Where do you allocate money? We can make an extra couple percent a year just in tax diversification and structurally setting up your accumulation and decumulation of money that people take for granted. So yeah, you could talk about the markets all day long. Here are the facts. You've seen it before from a million sources. This is not new. Stocks outperform bonds, outperform treasuries, outperform inflation. So if people want absolute certainty, you can put your money in treasuries, and you'll maybe or maybe not keep up with inflation after taxes. Probably not, because after taxes you'll likely end up a lower return than inflation. But that's certainty. But is that risk, or what is risk to someone is something that each person has to understand themselves. Is it the fear of losing money? Is it the fear of missing out? Is it the fear of inflation risk? Is it the fear of sustainability? Is it the fear of running out of money? Is it the fear of being able to support my children or grandchildren for college or tuition or business ventures or whatever your goals or ambitions? They're all unique to you. So everyone views risk through their own lens, but the facts are the facts. So I have to give credit to Carl Richards, who's beautifully annotated these wonderful images. Sorry, I can't help but draw. He's given me the itch to try to be creative like my son, who's an artist. But your lifetime return is essentially your investment return plus your investment behavior squared. Your behavior is going to have an exponential impact on your lifetime return than the investment decisions we make. And if we plan your path properly, forgive the P's or pass the P's, your lifetime returns are going to be a lifetime of abundance. So grateful that you took part in this webinar. I know I've maybe gone a little over the timeline, but we want to focus on facts over fear, abundance over scarcity, to ultimately give you the aspirations of life, liberty, pursuit of happiness, of freedom, safety, security, and sustainability for a lifetime. And here's my little cheat sheet. I altered it a little bit, but this is instead of searching the World Wide Web, this is my little cheat sheet, what I've been working on myself for seeking wisdom, wealth, and wellness. It's not just about money. You could take a screenshot of this. These are my habits that I've been working on to try to develop my own wisdom, wealth, and wellness. And to the degree that they're helpful to you beyond the profitability of your portfolio day to day, week to week, and measuring the outcome to say, John's a genius, John's an idiot, John's a genius, John's an idiot. It has nothing to do with me. You know, if anyone can calibrate day to day, good luck. You know, we're trying to calibrate for your needs and your circumstances. And if we can do that well, then I know it sounds crazy, but we just need to tie you to the post to prevent you from getting called by the sirens every day. And Big Ben Hart in our office, a new addition who's been a tremendous addition to the operation side of the business, has helped create family values for the firm. And the acronym Family Values with Bo and Ben and Jason and Christine and Louisa and Alicia and Stacy and all of our outside vendors. We've been blessed to have an amazing operational support team, from Fidelity to Betterment to Black Diamond to a lot of different technology providers, you know, that we use and we continue to use. And just we find a way. And we want everyone to have attention to detail, have focus on meaningful relationships, meaningful work, innovation, constantly looking for better, smarter ways to do things, focus on the long term, and help everyone understand their why. Our why is to help everyone live their own World Wide Web. And thank you for the opportunity to foster meaningful work and meaningful relationships. And now I'll turn it over to Christine for a little Q&A. Let me unmute you, sorry.
That's okay. Hi, everyone. Okay. So the first question we have is it different this time? It seems unprecedented between the politics, trade war, coronavirus, and what actions should we take? Jason, do you want to take that one?
Sure, no problem. Thanks, Christine. Yeah, I think the word unprecedented, I'm not making this up, but there is actually, we didn't include this chart, but I've seen charts where the word unprecedented during the month of March in terms of Google search ballooned, right? So the word unprecedented gets thrown around way too much. And again, just focusing on some perspective and knowledge. I learned about finance and investments through my grandfather, and I have a grandmother that's 101 years old. I recently joked with my grandmother that when she survives the coronavirus, she'll be one of the only people that survived both the coronavirus and the Spanish flu. So think about that. So my grandfather would have been roughly around 98 years old today. My grandmother is 101. They both survived unprecedented times: Spanish flu, wars, presidents getting ousted, multiple trade wars, right? So every single day is unprecedented. I joke around a lot with Jonathan and with Christine and everyone in the office that every single day we work up is going to be an unprecedented day. Nobody knows what the future is going to hold. So in terms of thinking about if today is unprecedented, of course it's unprecedented. Tomorrow will be unprecedented. 5 years from now will be unprecedented. But if you think about positivity and you think about the long term, all these small little unprecedented times are just a bunch of small blips on the radar screen of life. And again, it comes down to what action should we take? The action that we should take is the action you should have already taken. Goes back to the slide on jumping out of a plane and then saying, oh, I need parachute training. And that brings it back to planning and designing your path and coming up and constantly collaborating with us on your need, your capacity, and your willingness. Because these are actions we should have already been taking together, right? So if we designed collaboratively that path with you, no action should be taken together. There are some proactive actions that we have been taking in the portfolios in terms of focusing on quality and owning the most profitable businesses, tax loss harvesting, where we harvested, computing the dollar amounts from a tax perspective, saving clients in real dollars $800,000, $800,000 across our client base. That's real money. So these are actions that we're proactively taking during the time. But in terms of what actions should we be taking collaboratively between us and the client, these are actions that we should be making together all the time, because you don't want to take a step after you've jumped on the plane to now change your path.
Next slide. Okay, great job, Jason. What are your thoughts on developing an investment strategy in a time where the market fluctuates in such extreme ways as it is now? What does the long-term strategy look like? So I'll answer this one. Basically, if we refer to the slide John talked about the controllables, that's the long-term strategy. You want to optimize the balance sheet and cash flow. You want to have enough liquidity to get you through the next 12 months to cover expenses and for psychological safety. You want to continue to save and invest to cover your spending plus inflation plus taxes over the long term. You want to spend within guardrails. We normally recommend 3 to 5% of the portfolio value annually. And you want to make sure that the portfolio is aligned to your need, your ability, and your willingness for equities or growth or risk, however you want to term that. This is what we're calling the path, and it's absolutely essential to being successful and reaching your goals, whether that's retirement or passing assets on to the next generation. So, everyone's goal is different, but I think that, those are pretty good goals and they encompass most of our clients. So that's the long-term strategy, and foundationally, it hasn't changed. Okay, so the third question is, what extended window for a down market do you anticipate? What preparation should we consider in case this becomes a long-term financial depression? John, do you want to take this one?
Sure, thank you. As there is a lot of unknown unknowns. Part of planning and giving someone a perspective is to try to calibrate for the range of outcomes. And is it possible? Yeah, it's possible. And I just would caution the certainty of that outcome. If we had an extended window for a down market, first of all, I don't anticipate it. I don't anticipate that's trying to forecast what I think is going to happen in a short period of time. And as Charlie Munger and Buffett, say, forecasting should be reserved from adults and children and adults who act like children. It's a dangerous thing to. It's a degree of arrogance to think that what government policy is going to be tomorrow, that they were going to step in or not step in, or they're going to change regulation tomorrow or today to decide who's going to live and who shall die. I mean, there's so many factors to know whether tsunami is just one wave or multiple waves. I have no way to anticipate it. That being said, if you're certain that that's what you're trying to brace and protect from, and that's the structure that you need, then let's think about that in two lenses. Number one, if you really believe that we're going to be in the depression and the markets are guaranteed to decline 80% like they did in the depression, which again, I just don't believe that's probable, but it's possible. If you believe that's probable and you're worried about that, the only thing you can own is US Treasuries. And the reason why is because US Treasuries at zero, they're not paying you anything, which has also been helping them borrow money. That rush, everyone's been worried about the depression, so everyone's rushed to buy US Treasuries. You're letting the government finance that pitfall or that hole, which is great for the government. And the government has done what they should do, is basically continue to raise trillions of dollars. If they raised another, 3 trillion or 5 trillion or 10 trillion, whatever number, if you were able to borrow money at $1 trillion or $10 trillion at 0% interest, wouldn't you? I mean, what's your risk? They can print money. They have their own currency. And, Jason touched on, how that actually works. But if you have all your money in treasuries and you're worried about security prices declining in the next 20 years, and you own treasuries, you'll earn nothing. And then you just have to control your spend rate proportional to it. But I was thinking about this during this last couple of weeks and looking at my credit card bills. My credit card bills are all the companies that Jason referenced. I have credit card bills from Apple, from Amazon, from, I'm using Microsoft to do this presentation. I mean, all of the companies that are showing up that are necessities in my life are profitable businesses. So at least if I'm spending money, if you're worried about depression, you still need to spend money for stuff. You still need to spend money for food, clothing, shelter, there's the money you're going to need to spend. So think about calibrating the idea that you are actually still spending money, and people are still spending money even in depression. Our whole idea of framing this perspective conversation is to reframe it from, okay, if you have enough liquidity to prepare you from an asset liability perspective, 1 year, maybe you need 5 years, maybe you need 10 years. Okay, let's talk about it. If you have 10 years of cash, again, going to Buffett's idea, I have $134 billion of cash. Okay, I don't need to be a forced seller of anything. And then the question is, do I believe the assets I hold are going to be worth less in 10 years or not? Because in 10 years, do I think that asset prices will generate a return higher than 1%? I do, because I choose to believe in an optimistic light. But if you believe that a depression is a certainty, then how much cash do you need that you can invest for a profitable future? And not look at the values day to day as Buffett, not having to respond to a $50 billion loss in a quarter. He has enough cash and enough profitability that he doesn't have to worry about the next quarter. So you have enough balance sheet and liquidity to be able to, and cash flow to be able to not worry about your asset prices day to day, week to week, month to month. You can calibrate in a way that you can think long term and not worry about a depression, and then show up healthy and make a greater impact in the people's lives that you're able to influence. The one little anecdotal thing it reminds me of two other little small things, just graphical depictions that I remember. People are so salivating for perception of stability, of less volatility, that they pile into really complex assets, whether it's structured products or, I remember back in the 90s, the brilliant Nobel laureates had created this long-term capital management that was generating tremendous returns with no volatility. And then in 1998, they basically went to zero. So the reason we index most people's money and try to be as passive as possible is we're not trying to be, geniuses and outsmart everyone, because if you're trying to outsmart everyone, you have a great risk of basically collapsing yourself at some point in time. So we just have to own the collective conscience of the world and just marginally lean toward the most profitable businesses, and maybe we'll get a slight premium, but we don't need to do anything so dramatic. We could just do it on the margins. But doing anything too extreme is going to lead to a big problem. And then also to frame it, as Jason said, the Great Depression was a blip in time. Yes, if you're living on it and you're counting on the money in this period of time, this is where planning becomes extraordinarily crucial, that we look through someone's balance sheet and take an x-ray of your balance sheet and cash flow to be able to weather whatever is going to happen, because this storm may pass and another one's going to happen. As Jason said, it happens every 7 years. It's not like a clock that it's going to happen 7 years on average. It could happen again 6 months from now. It could happen again 6 years from now. It could happen again 10 years from now. It could be 20 years from now. They're not spaced. Tsunami waves don't happen in predictable patterns. So with that, you've been very generous with your time and patient to listen to my team's rambling. Jason and Christine, thank you for sharing your wisdom and intellectual presence. And I wish everyone a wonderful Mother's Day. Unless there's any last questions, the chat box are open. If anyone wants any last minute questions, they can throw in a question on the chat box. I want to thank everyone with great gratitude for the opportunity to serve you and your families, and to think with great gratitude each day for the blessings that you have in your life. Try to search inside yourself versus searching to validate the Great Depression or pessimistic information. Remember, the media sells fear. So if you're going to let it get into your insides, it's not going to enable you to see sunflowers and sunshine. So forgive the hokey finish, but happy Mother's Day on that note.